Hello again, and welcome to the next installment in our series of 4 videos. This video is going to be on our new benchmark tab, which for students in money management is the main tab that I, your host, James, it will be working on each month, and something that you should really have a good understanding of for anyone in sim, whether it your first semester here or your 8th semester here. So this video is really to give you a good understanding of each of the 7 tabs that we have in our new benchmark tab, what our benchmark looks like, how we go about calculating it, how do we go about choosing what it was, etc. So I guess to get things started, and we've already talked about the portfolio analytics and the diversification spreadsheets. So let's talk about, after we know what our portfolio is worth, what do we compare that to? Because we could say, oh, our portfolio earned 12% this year. Is that good? We don't know. It may be good if the rest of the market earned 4%. It may be bad if the market earned 20%. So it's all dependent on what you set yourself up against. And that what we've chosen to do is based on our style and size diversification. So we talked in portfolio analytics about exchange traded funds and how they track certain industries, certain markets, certain companies, etc. So we use these comparable ETFs with our style and size diversification to create our benchmark. So for instance, we talked about the 9 different plots on our grid from Morningstar. And you'll see all those here in our equity derivatives. So right here, you'll see all 9 of them there, and you'll see a comparable ETFs column. That's B. So let's zoom in here for you. And you'll see this comparable ETFs column here. So these are all tickers for ETFs that track certain things. So for example, VUG. This tracks large cap growth stocks. VV tracks large cap blend stocks. Blend is another name for core, which we have expressed in our diversification tab. And VTV tracks large cap value stocks. We have one of these for each of our 9, and we also have one for each of our 6 fixed income government, corporate, short, intermediate, and long breakdowns for those as well. In this weight tab, so like I said before, we have to do our portfolio weights in accordance with what our portfolio is and what our market values are in each of our industries, each of our styles and sizes in this case. So we take the weight of the portfolio in terms of its style and size, and we input those here. Over here in the ending price, we take the beginning price, which is right here, our starting price, and we input our ending price, which is this VUG. And then after entering all of our ending prices, we find what the value of our portfolio is. And how do we do that? Well, that's right over here in this cell. We paste that here. So here's our here was our value for last month for our benchmark. Because what this does is it basically and essentially takes all of our weights for our portfolio and using comparable ETFs looks at a portfolio of ETFs that have the same weights, looking at the same kind of returns, and see how well we do against that. So that would be our benchmark tab. Now, I don't think a lot of people would be using this tab, as usually the head of analytics does all of this. So it's good to know and explain the benchmark, and this is one good way of understanding it. The changes tab, which I'm going to now, all the weights that I was talking about, these all get entered here for every single month. That's all that this is. That's all that the spreadsheet shows. So I won't spend too much time on that. Our values tab, this is a pretty important one, and like it looks, it's got a lot of different numbers here. So I'll zoom in a little bit so we can give a better look at what we're looking at. So we've got the date running down in the A column here, and then we've got all of our different benchmarks and indices. So you'll see a bunch of different colors as you go along, and each different color represents a different benchmark that we use. Our black one is our custom benchmark, which I just talked about over in our benchmark tab. We have the S&P 500, which is the 500 largest cap stocks. We have the Vanguard 60/40, which is an index that is 60% equity and 40% fixed income. We just implemented this one for comparison purposes because we thought it was a pretty good match with our fund. We have the PIMCO Total Return Fund, which is it's a fixed income type fund. We have the Russell 2000, which is a volatile index because it contains the 2,000 smallest cap stocks. So 2,000 small stocks are going to be a little bit riskier, going to be a little bit more volatile in the month-to-month gains and losses. We have a global hedge fund, which again, this one it's very it's got a pretty low risk factor, unlike the Russell 2000, and we'll see that as we move along to our charts and our scattergrams. And then we have the MSCI World Index, and that's just an index that weights different geographic regions. So at the end of each month, we come up to a value of our total portfolio, just like we have the S&P 500 and the Vanguard 60/40 has an ending value for the month. And this is basically a place where we compare our ending value with their ending value, and more importantly, all of these gains right here. So everything that I'm highlighting, these are all of our gains on a month-to-month basis. So we'll see, this is all that this tracks, this tab, but we'll see in the charts why this is important. The next one is the returns tab. This one's got a lot of numbers on it, and it's really not important for you to know too much about it, so I'm going to skip that. And next is our charts tab. This is actually a pretty important tab, just because it really puts into perspective those percentages I was talking about earlier. So we've got our portfolio in here, and we've got the other 7 indices that we look at. So we've got the S&P 500, the Russell 2000, our benchmark, the World Index, the 60/40, our portfolio, our global hedge fund, and PIMCO. Now, when we're looking at this graph, what we did was we took, in March of 2010, we took $1. It's a theoretical dollar, not a real dollar. And we took that dollar and we'd say, okay, if we invested in each one of these 8 different hedge funds, these different indexes, these different portfolios, how much would we earn over time? And so each month we have a return. That was those percentage gains that you saw. And throughout the years, it has grown and shrunk over each month based on how the portfolio does, how the S&P 500 does, how the Russell 2000 does, etc. And what we've learned is that at the end, the S&P 500, the Russell 2000, our benchmark, MSCI World Index, and our Vanguard 60/40 are currently outperforming the portfolio, whereas the Global Hedge Fund Index and PIMCO Total Return Fund are not, which is to be expected because they are less risky. Now moving forward, we have in front of us is a risk-return scattergram. And what this shows on the y-axis is annualized returns. So I talked about a little bit before about annualized returns, how if you have a return for a stock over a period that's shorter or longer than 1 year, you have, to make it comparable, what we do is we annualize it, and we say, okay, you may have earned 20% over 5 years, but what is that a year? So we look at our annualized returns opposed to our nominal returns, and then standard deviation, that is our comparison factor for risk. So what you do is you plot each of our portfolios on this scattergram, and what you see is you get an idea for what the most risky and where the most return is on each of these 8 different investment vehicles that we use to compare ourselves. This also includes our portfolio in total, and a breakdown of the Bank of New York and TD Ameritrade. So things to read off of this chart for the month of November 2014 is that the Russell 2000 is risky. Standard deviation almost 20, but there is return for risk. So when you take a class with Jim, he likes to tell you that if we look at this picture as a map of the United States, we want to get to Seattle, which is this way. So we're trying to get up to Seattle. I'm going to move them. Oh, that's not what I want to do. So we want to move up to this grid up here, where our risk is as low as possible and our return is as high as possible. Now, realistically, that's not going to happen. If that were the case, that whatever fund that was would have the most investors in it in the world. So it's usually, a positive correlation. You'll see it looking kind of like this, which is normal. As you'll see in the finance classes, the security markets line kind of runs this way, which, as you'll see, the optimal portfolio is somewhere along that line. Now, as you move forward here, this just shows a little bit more analysis for our annual report, looking at quarter ends. We need to finish all our quarters before we can do this. So there's that. And so this is our charts page. Next is a pretty new. It was made this semester. It's a ratios and analysis page. So we looked at for the fiscal years 2006 through 2014. We looked at the returns for the portfolio, but we also measured the S&P 500 and the benchmark in terms of those returns as well, and looking at excess returns. We also have a group of ratios over here, the Trainer ratio and the Sharpe ratio, which are in academia, there are ratios to look at in terms of performance measures and outperforming or underperforming our benchmark. And then down here we have we've got basically a running total of the market value of our portfolio and each of the other funds. So there's that. And our last page is just the results again of what we found over here on the values tab. So this, these numbers all coming into this results page. We just do our portfolio, the benchmark, and the S&P 500. We take those three for the month of November, and our outperformance obviously is our return versus the benchmark's return. So if the benchmark has earned more, has increased in value at a greater percentage than our portfolio, that number is going to be negative like it is in November. The next group of columns over is quarter end, and the group after that is year to date. So when we're looking at that, that basically gives a pretty good picture for how we calculate our benchmark, how we denote our changes in the benchmark, or changes in weights, where we keep track of all of our historical percentage gains and losses and values for each of not only our accounts and our total portfolio, but also our benchmarks. And then we've got some graphs and a risk return scattergram, which provides a little bit more insight as to how risky our fund is in comparison to, again, these other ones. So that'll do it for today. I've got one more video left, and that one is working with our realized gains tabs. Again, I talked about how there's a difference between unrealized and realized gains, and I'll get into a little bit more about our realized gains tab in that video. So thanks for listening, and we'll see you next time.